Hey everyone, welcome back to Corporate Decoder, the place where we unravel the fascinating and sometimes bewildering world of corporate finance. Today we're diving headfirst into a new fund's launch documents, and let me tell you, it's a wild ride filled with complex strategies and a whole lot of risk. So imagine you're thinking about investing in a new fund, the Calamos Aksia Hedged Strategies Fund. This isn't your average mutual fund you'd find at your local bank. This is a closed-end interval fund, which means it does things a little differently, especially when it comes to getting your money back. Before we jump into the nitty-gritty, if you love breaking down these massive corporate filings and getting the real story behind the numbers, hit that subscribe button. And hey, if you want to chat about these filings with fellow corporate nerds, join our Discord community linked in the description. Let's start by looking at the big picture. This fund is all about getting long-term growth while trying to keep a low sensitivity to the stock market. How are they planning to do that? By investing in a bunch of other funds, often called hedge funds, that use all sorts of fancy investment tricks. It's like layers of investment, and with each layer you can imagine come new costs and new risks. Right off the bat, they're upfront about costs. If you buy Class A shares, you might pay a sales charge of up to 2.25% just to get in. That's a chunk of your initial investment gone before it even starts working for you. Other share classes like Class C, I and M don't have this front-end charge, but they have their own fee structures, which we'll get to. Now this is where things get really interesting. Look at the total annual fund expenses after reimbursements. For Class I shares, it's a projected 17%. That means out of every dollar your investment earns, 17 cents goes towards running the fund. For Class C shares, it's a hefty 18%. On a $1,000 investment earning 5% a year, that's over $118 in fees in the first year alone for Class C shares. That's high, and it really cuts into your returns. It's like paying almost a fifth of your earnings in fees. A massive part of those expenses, around 15.5%, comes from acquired fund fees and expenses. This is what it costs to invest in those other hedge funds. Think of it as paying fees on top of fees. You pay for this fund, and then this fund pays fees to the underlying funds it invests in. It's all these layers of expenses that eat into your potential profits. Their main goal is long-term capital appreciation with low sensitivity to equity markets. They plan to achieve this by investing at least 80% of their assets in these alternative funds, which are basically hedge funds and direct investments. They're not putting all their eggs in one basket, but they are putting them into many baskets that all operate in a similar complex way. Now, this fund structure itself is important. It's a closed-end interval fund. What does that mean for you as an investor? Unlike a typical mutual fund where you can sell your shares any day, here your options for getting your money out are limited. They offer to buy back shares from you quarterly, but there are limits. They might not be able to buy back all the shares you want to sell, and a huge chunk of their investments are expected to be illiquid. So this is definitely not a fund for quick access to your money. This fund is brand new, operating under an agreement from March 2025. They mention a predecessor fund, which is good because it gives us some historical performance data, albeit from a private fund that had different rules. For example, the performance of that predecessor fund showed positive returns in 2024 and the first half of 2025. But remember, past performance is never a guarantee of future results, especially when they're transitioning to a new structure with new regulations. There are two main players here, Calamos Advisors LLC as the main advisor and Aksia LLC as the sub-advisor. They manage the fund's investments, and their expertise is crucial, especially since this fund relies heavily on their ability to pick good underlying hedge funds. The success of this fund largely depends on the talent and decisions of these advisors. Leverage, this word always makes me pay attention. The fund can borrow money to boost its investments. While this can amplify gains, it also magnifies losses significantly. Borrowing money is like adding a turbocharger to your investment. It can make it go much faster, but it also means you can crash much harder if things go wrong. This is a really big risk. They explicitly state there's likely no secondary market for these shares. This means if you want to sell your shares, your only real option is through this fund's repurchase program. And as we said, that has limitations. So you should be prepared to hold on to this investment for a very long time. Let's talk about Class C shares and a specific scenario. If you invest $100 in Class C shares and redeem them within the first year, you'd pay about $10 in what's called a contingent deferred sales charge. This is on top of the other fees we saw that are much higher. So while that $10 sounds small, it's just one small piece of the overall cost. They aim to be a regulated investment company, or RIST. This is important for tax purposes as it generally means they avoid double taxation. But to stay a RIST, they have to follow strict rules about what they invest in and how much income they distribute. Failure to do so means they get hit with corporate taxes, which would hurt returns for everyone. Valuation is another major headache here. Since they're investing in private funds and complex instruments, getting an accurate value for these investments is tough. They often rely on the valuations provided by the hedge funds themselves, and there's definitely a risk there. It's like asking someone to appraise their own house and trusting that appraisal completely. Derivatives, these are complex financial contracts whose value depends on an underlying asset. They can be used for hedging to reduce risk or for speculation to increase potential returns. However, derivatives can also introduce significant risks and complexities, magnifying both gains and losses. They might also invest in PIPEs, which are private investments in public companies. This can be tricky because these investments are often restricted and can be hard to sell. You might get a good deal up front, but getting out could be a challenge. They can also buy into these hedge funds on the secondary market. This means they might be buying existing stakes from other investors. This can be faster than investing directly. But it also comes with its own set of risks, like inheriting any hidden liabilities or not being able to get official approval to be a full partner. It's important to note what they can't do. They can't buy real estate or commodities directly. Their focus is strictly on financial instruments and these underlying alternative funds. This helps define the scope of their investment universe. Let's look at the leadership. The board has 5 members, with 3 of them being independent trustees. This independence is crucial for overseeing the fund and ensuring it acts in the best interest of shareholders. Having experienced individuals like John Kudunis, who has a background in global securities and leadership at Mizuho Securities, and Jim Voss with extensive alternative investments experience at Credit Suisse. On the board adds some credibility. Remember those different share classes we mentioned? Class A has that front-end load. Class C has a deferred sales charge if you sell early. Class I is for big investors with high minimums, and Class M has its own fee structure. The choice of class really matters for your costs. This fund is very new. It was legally formed in March 2025, and as of August 2025 they've only issued 10,000 Class I shares worth $100,000 to Calamos Advisors LLC, the main advisor. This means the fund is essentially still in its infancy, and that initial investment is just to get things rolling. As of December 2024, the predecessor fund, Calamos Aksia hedge fund Access Core Alpha LP, had investments totaling over $5.3 million. Most of that, over 99%, was in hedge funds, and around 5.2 million of that was in investments restricted for resale. This highlights the illiquid nature of their strategy from the get-go. Looking at their actual investments in the predecessor fund, they had stakes in various hedge funds across different strategies like event-driven, long-short equity, multi-strategy, relative value, and tactical trading. The fair value of these investments as of December 2024 was more than their cost, showing some positive unrealized gains. However, it's a concentrated portfolio with almost all of it tied up in these hedge funds. Now let's talk about the story here. This filing is about launching a new investment fund that plans to invest in other investment funds, mainly hedge funds. It's a complex strategy with high fees, limited liquidity, and significant reliance on the expertise of the fund managers. The fact that it's a closed-end interval fund means investors need to be prepared for a long-term commitment and understand that getting their money out quickly isn't an option. The high acquired fund fees, combined with the fund's own expenses, mean a substantial portion of any returns will go towards costs. The potential for leverage adds another layer of risk. So what's my take on this? This fund is definitely not for the average investor. It's designed for sophisticated investors who understand the complexities of hedge funds, the risks of illiquid investments, and the impact of layered fees. The strategy aims for long-term appreciation with lower market sensitivity, but that comes with a significant price tag and a lack of day-to-day liquidity. The valuation risks and the reliance on underlying managers' performance are also major concerns. It's a high-risk, potentially high-reward play, but the fees and structure are a big hurdle. Alright, that's our deep dive into the Calamos Aksia Hedge Strategies Fund filing. What do you think about this fund's strategy and its fee structure? Are you intrigued by the potential rewards or wary of the risks and costs? Let me know your thoughts in the comments down below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community for more discussions and insights linked in the description. Thanks for watching, and see you next time on Corporate Decoder.